Now we're just going to do a brief update on the ECB and Europe in general. And here you can see the ECB Governing Council. You can see that they're leaning more towards the hawkish side, which it makes sense when you look at the amount of inflation that is there, the amount of pressure that remains to be the case. So we do see that progressing. So again, we've been talking about it consistently. There's a lot of problems that are there. The rates are just starting to go positive. There's still a lot of liquidity in there, and they need to pull this out. Now, there's supply side inflation that remains, that problem that isn't going to go away. We talked about the Rhine River falling again. We continue to see that as a problem, but it doesn't mean that there aren't other issues in terms of a significant amount of liquidity that's in the system that has to get pulled out, which is why when you look at the Eurozone market implied changes in the overnight rates, you're continuing to see an increase in those rates in general. You know, there's some that are expecting those rate cuts in 24. For those that have been following us, we don't see rate cuts. You know, the problems are remaining. PPI in Germany is the only thing that I think is at the top of the list to talk about. When you're looking at some of those pieces, you know, PPI month on month was expected to be up negative 0.7, came in at negative 1.4. Year over year, it's only up 1%. So you're starting to see some of that slowdown, but again, it takes time to filter through, and now you're starting to see natural gas prices go back up. You're starting to see profitability on petrochemicals and fertilizers getting hurt again, which is that kind of bridging some of that gap when you look at what has come down. And as we showed in segment 1, you know, Europe is still in a problem spot when you look at inflation, inflationary pressures, and that's not going to be reversing in the near term, which is why we see those rates going up. Eurozone Construction PMI continues to be in negative territory. The output on three month over 3 month latest value continuing to kind of is April and came down a bit. So again, you're just looking at things moving in the wrong direction when you're looking at just underlying value on a PMI basis and then the output. So because when you look at PMI construction being in contraction, it'll keep pulling down that output, and you'll keep seeing that again reduced to a smaller level. And then one quick mention on UK. The CPI report delivered yet another massive shock, with core inflation breaching 7%. Expectation was for 6.8%, came in at 7.1%. So you saw, again, that reversal back up, and we continue to see these problem points with those reversals. And it's not even that they have to break to new highs. It's just, again, keeping that elevated stance, which is why the BOE is going to have to keep rates elevated. You're not seeing this big inflation correction as supply side issues have diminished. Obviously, the UK has its own supply side issues, but it's not just about the supply side inflation. There's more behind that. There's just over a decade of just easy money, inflationary backdrops, you know, liquidity being pushed into the market, and it takes time to take it out. And that's why you're seeing a lot of this stickiness, which is why when we turn to China in the next segment, we're going to see more pressure in that sense of you can't just ease your way to growth. The law of diminishing returns is real, and you're going to continue to see that impact, which is why we want to look at, even though the debt is available, can you actually move it through the system? And that's where we want to move to next when we turn to the Asian markets.